Good morning, everyone. Here's your market update for the 10th of November. The US dollar index fell sharply below the 100 mark in the latter half of last week, as signs of a cooling US labor market fueled expectations that the Federal Reserve could cut rates in December. The weak labor market weighed on both the dollar and bond yields, pushing the index below the 200-day moving average of 100.26 and under the psychological level of 100. This movement came as a prolonged government shutdown delayed official employment data, forcing traders to rely on private indicators. One key report showed that more than 150,000 jobs were cut in October, the highest for that month in over 2 decades. This is largely due to the AI integration and cost-saving measures. Meanwhile, comments from the Chicago Fed President Austin Goolsbee reminded markets that without complete inflation data, the central bank must remain cautious before easing policy can continue. The dollar also faced additional downward pressure from other major currencies, as the euro strengthened and the Great British Pound rose after the Bank of England held interest rates steady. The dollar's decline against the yen was particularly sharp as investors sought safety amid broader market uncertainty. So technically, the dollar index confirmed the move below its 200-day moving average as it shifted short-term sentiment to bearish. If selling pressure continues, the index could test support near the 99.37 level and potentially a move down to 99. Resistance remains at the 100 and the 100.36, where the index previously struggled to break higher. So now turning to crude oil, with WTI trading between 61.30 and 58.75 last week, ending near the lower end of the price range. Prices were pressured by ongoing concerns over oversupply and a stronger dollar earlier in the week. According to the US Energy Information Administration, crude inventories rose by more than 5 million barrels in the final week of October, reversing the previous week's large drawdown. This increase added to the fears of a market glut. However, some geopolitical developments offered limited support for oil prices. Reports suggested that the US military activity could intensify around Venezuela, one of the world's key oil producers, while Russian crude exports were disrupted by some drone attacks around oil refinery infrastructure around the Black Sea region. From a technical perspective, WTI has broken below its short-term moving averages, forming what's known as a death cross, a bearish signal suggesting that momentum remains weak. So the 14-day RSI is hovering near the lower end of the zone, indicating subdued buying interest. If prices fall below the 58.75, further declines may lead to 58 or even to the October low of 56.35, which could continue. To regain strength, oil would need to recover above the $60 level, then hit 61.30, signaling a potential end to the current downward trend. So next we'll look at gold. Gold prices fluctuated around the $4,000 per ounce mark last week, caught in a tug of war between safe haven demand and profit taking. The weaker dollar provided earlier support, while ongoing uncertainty surrounding the US government shutdown also contributed to safe haven buying. At the same time, concerns about the US labor market weakness and the expectations of lower interest rates continue to support the precious metal, as lower rates reduce the opportunity cost of holding gold. However, volatility in US equities limited gold's gains. As markets corrected sharply, investors liquidated their gold positions to raise cash, dragging prices lower. Technically, gold has been consolidating after reaching a new high of 4,381 last month. It has since corrected to around 3,950, but remains above its 40-day moving average, which continues to act as strong support. If gold can maintain this level, the next resistance lies between 4,046 and 4,050, with a potential move higher towards the 4,154 or even $4,200 mark. On the downside though, if prices continue to slip, 3,928, they could even revisit the October low of 3,886 before finding some new buying interest. Finally, the Australian dollar continued to weaken against the US dollar last week, dropping from 65.62 to a near 4-week low of 64.58. The decline was driven partly by disappointing trade data from China, Australia's biggest trading partner. China's October trade surplus narrowed as exports fell by 0.8% year on year, reflecting softer global demand. So imports rose modestly, but not enough to offset the decline in exports. So these numbers highlight the ongoing fragility of China's recovery and, by extension, its impact on commodity-linked currencies such as the Aussie dollar. However, there were some positive developments on the trade front, with the US announcing a one-year suspension of certain tariffs on Chinese imports, while China said that it would remove some tariffs on US agricultural products starting the 10th of November. Such measures may ease tensions between the two largest economies, providing some momentary term support for the Australian dollar. Technically, the Aussie-US pair remains under pressure, consolidating below the 65-cent mark. The pair is trading beneath the 9-day moving average, suggesting weaker momentum. Support lies around the 64.40 and the 64.14 mark, with stronger backing around the 63.70 mark. On the upside, a break above 65.30 and the 50-day moving average at 65.60 would be needed to restore some short-term bullish sentiment. Overall, markets are in consolidation mode, balancing strong US data with expectations for slower global growth and potential central bank easing headed toward the year end. That's all for this morning's market update. I'm Alex, and thank you for tuning in, and we'll see you tomorrow for some more insights.